Welcome to today's Q3 2023 market update and outlook. We so appreciate you all spending some time with us today. I'd like to go ahead and introduce our presenters. We've got Mazen Dana, who's a senior applied scientist here at Uber Freight, Matt Harding, head of 4PL data and analytics, and Matt Lowry, who's the director of procurement for today. Our agenda, we're going to start by hitting some macroeconomic and supply chain trends, moving on to transportation management 4PL market trends, a lesson truckload update, 12-month market outlook, and then we'll close it out with some live Q&A. As we go out through the day, feel free to drop any questions that you have into that question box you should see within your tool, and we'll address all of those at the end. Thank you, and I will go ahead and kick it off to Mazen.
Thank you, Rebecca. So starting with the macroeconomic update, I'll start with covering what's happening with the supply and demand dynamics in the truckload industry. So for those of you who are not familiar with these indices that we share on a monthly basis, there's a supply index reflecting how much capacity is there in the market, measured by the number of employment in trucking and the number of trucks. And there's a demand index that reflects how much the truckload demand is out there, measured by consumer spending, wholesaler sales, manufacturing shipments, imports, and exports. So when we combine all of these and we give them the proper weights, we end up having a demand index that captures aggregate truckload demand in the industry. And when we look at this index to the left, the demand index is shown in blue. We see that demand has probably found the bottom around March of this year. In the 3 months following that, April, May, and June, we have seen increases. We don't have all the data for July and August yet, but for the 3 months after March, we saw increases in truckload demand. Now, demand is still 2.5% lower year over year. So it is still like negative year over year, but we believe that at least temporarily we have found the bottom. In terms of supply, we have seen some stagnation over the past month, although the supply as of Q2 was still 5% higher year over year. So this was driven by a surge in hiring that happened in early last year, and we're still feeling the year over year effects of that surge that happened around April of last year. We have also seen an influx of equipment coming into the market, as a lot of carriers have placed orders for trucks several months ago, even back when there was a shortage of equipment and semiconductors. They're still receiving these trucks. So we're still seeing an increase in the number of equipment. There's a lot of carriers who are failing, yes, but we believe a lot of these are also enrolling with larger fleets, helping to keep supply more resilient than many have expected. When we take the difference between our supply index, our demand index, and our supply index, as we can see on the right, it is very highly correlated with the spot rates. So especially when we adjust spot rates for inflation and seasonality. And that tells us that the market remains oversupplied. Rates indicate that this is a result of a gap between supply and demand. Supply is exceeding demand for maybe like 12 months in a row now. But what we should expect in the coming months is that we should expect supply moderation, and I'll cover some of the reasons for that later. Why we should expect supply moderation. So we expect the gap between supply and demand to start closing, and not necessarily because demand will surge, but because supply is expected to correct over the coming months. Now, moving into the details of what goes into the demand function that I just discussed, I'll start with some consumer spending on goods. So starting with the downstream spending on goods, this data from the Bureau of Economic Analysis showing spending on durable goods and non-durable goods. So durable goods are things that we consume every once in a while, like furniture or vehicles or appliances. Non-durable goods are things that we consume on a day-to-day basis. And when we look at the Q2 data, we see that spending on durable goods actually rose, while spending on non-durable goods almost remained flat, maybe like rose slightly. And this is even after adjusting for inflation. So this is not just the price of these goods going up, but the actual consumption is still going up. Now, it's not going up at the levels that it has went up historically. Like historically, we've seen an increases of in the range of 3 to 5% maybe every year in consumption. Now we're not seeing that. We're seeing like maybe 1 to 2%, but we're still seeing an increase in consumption year over year. And this is mostly driven, as I said, by spending on durable goods, which is still 12% above its long-term trend. So if COVID hasn't happened, we would expect, according to this dashed line trend, we would expect spending on durable goods to be maybe like 12% lower than where it is today. So what are the reasons that the consumer is still holding? I would mention a couple of reasons. Spending on goods has been supported by growth in real disposable income. So over the last year, even after adjusted for inflation, incomes have increased by about 4.7% year over year. This is due to unemployment, to low unemployment rates. The job market remains tight, and the economy has started showing signs of recovery. Inflation is going down as well. And then the other reason, which is maybe more negative, is that consumers are saving less to maintain high levels of spending. So prior to the pandemic, we have seen that the consumers were saving about 7 to 8% of their income. And right now, they're saving only about 4.2, 4.3% of their income. And this is well below the pre-pandemic average. So consumers are saving less in order to maintain spending not only on goods, but also on services. And we don't know whether that will be sustainable going into next year. So that's on the consumer side. Going more upstream to the manufacturing side, we have seen the manufacturing sector contracting for maybe 10 months in a row now. In all 3 months of Q2, we have seen contraction according to the ISM PMI, which is a survey-based indicator of the manufacturing economy. So it measures different sectors of the economy, and any value below 50 in this chart indicates contraction. Any value above 50 indicates expansion. The latest ISM observation was 46.4 in July, which is below 50. So it indicates that the whole manufacturing economy is indeed contracting. And what really I look at is the backlogs and new orders. So these are early indicators that show how much freight or manufacturing demand is in the pipeline. And these are well below 50, even though they have been increasing in the past month, which means that the rate of decline has been moderating, but demand hasn't found the bottom. We expect more decreases over the coming months. Now, there's a little bit of a disconnect when you look at data from the government or like the Federal Reserve or the US Census. They show that the manufacturing sector maybe hasn't been doing that bad. Maybe manufacturing output is flat, or manufacturing orders are going up. And I would say that the difference is that we have to look at a sector by sector basis. So the government's data is maybe aggregated over different industries, and most of the strength has been recently driven by a few sectors in the economy, the auto industry mostly, machinery, demand for machinery, some durable goods, but otherwise a lot of sectors are contracting. So this explains this disconnect. Like there's some strength in some few sectors, but the majority of sectors are still seeing contraction. Now, what are the reasons? Some of the reasons of the manufacturing weakness. I'll start with inventories. So this chart shows the year-over-year changes as of June in wholesale inventories and retail inventories. Starting with the wholesale inventories of non-durable goods, we have seen a 7% decrease year over year. So this means that wholesalers are trying to control their inventories. This was mostly driven by a decrease in farm products and petroleum, but we have seen also broad decreases year over year in wholesale inventories. In durable goods, we have seen an increase year over year. This was mostly driven, as I said, by auto and machinery, but the rest of the sectors are contracting. So for sectors where we have some pent-up demand, like auto, wholesalers and retailers are still increasing inventories. When you look at retail inventories of auto and parts, it's 25% up year over year. This reflects how much pent-up demand is there. But the good news is that inventories for all of retail, excluding auto, are down or like maybe flat year over year. They're only up for a few sectors, but the majority of retailers are also trying to control their inventories. The only sector where I would see that maybe inventories are still going in the wrong direction might be machinery, might be like some durable goods in the wholesale sector specifically. So Inventories are trending in the right direction, but sales are trending in the wrong direction. So this chart shows the inventories to sales ratio in the 4 sectors that I showed in the previous slide. We have seen that even though inventories are coming down in non-durable goods and in retail, excluding auto, the inventory to sales ratio was still trending up. It has exceeded the pre-pandemic levels, or at least went back to the pre-pandemic levels, and for several sectors. The most worrying, as I said, is the wholesale of durable goods. This is where we have the highest inventories to sales ratio, followed by the wholesale of non-durable goods. So we have higher inventory levels relative to sales in the wholesale sector. In the retail sector, retailers have done a good job controlling their inventories. We have been flat mostly over the past year. And finally, the last sector where we really still have a shortage of inventories is the auto and parts. Even though we have seen a huge surge in inventories recently, it is still very low relative to sales, at least relative to historical levels. So we expect more increases in inventories in auto and parts. But for the rest, I expect inventories to continue normalizing, at least relative to sales. So that's all on the demand side. Now going to the supply side, focusing mostly on the truckload landscape. This chart is from FTR based on FMCSA's data, and it shows the total number of carriers entering and exiting the market. So these are new authorities given by FMCSA and authority revocations, which means that these are carriers that are losing their authority. This is independent of the carrier size, so no matter what it is, whether it's a 1,000 employees, 1,000 trucks carrier, or a single owner operator, this counts as one observation in this data. And what we have seen is that in the past year or so, the market has lost close to 16,000 carriers who had their authorities being revoked. This is this is maybe the highest number of revocations we've seen in the history of the data, but it remains small compared to all the entrants that have entered the market in the past 2 years, which is 125,000 carriers. So the market hasn't fully corrected yet. It remains extremely oversupplied. And even though a lot of these carriers are exiting the market, many of them are still finding jobs with larger carriers. So they're shifting from being owner operators to being company drivers, without a net reduction in supply, as we saw in the previous 2 slides. So supply hasn't been decreasing meaningfully yet. My expectation is that in the future, these trucking companies will reach their hiring capacity, and then we will start seeing a net reduction in capacity. The other data point that we look at is trucking employment. So this is the number of employees in trucking. I'd like to focus on the long distance truckload sector because I find it a better predictor of rates. And what we have seen is that for-hire trucking employment has remained flat over the past year or so. The last observation, it has decreased slightly. It's maybe flat year over year, but long distance truckload employment is still 1.5% higher year over year. In the last observation, which was, I believe, in June, it lost 0.3%. We expect this trend to continue. We expect the supply to continue to contract until it's back in line with demand. What are the reasons for that? The reason is that when we look at the same data source, which is the Bureau of Labor Statistics, it shows us the driver productivity, and that represents how many hours are employees working per week. When we look at that data, we see that maybe 2 years ago, drivers were working 43 hours. Last year, they were working 42 hours, and this year, they're working maybe 40 or 41 hours per week. So there's a significant decline in productivity that is well below the 2019 levels, well below all the historical levels seen before. And this indicates that maybe carriers will not need drivers anymore and will start controlling their headcount. So with that, I'll hand it to Matt to talk over some of the 4PL trends.
Yeah, thank you, Mazen. So yeah, great overview on the economy there. We're going to pivot into the 4PL systems. We're going to talk quickly about what we're seeing on the route guides and what that means for rates. And then Matt Lowry is going to follow me. Obviously, with Yellow Freight in the news, he's playing point on all of the very, very recent events. So we wanted to add some LTL in here. So we're going to cut this a little bit short. The net is, if you look at route guide compliance, did the delivered load come from a route guide versus an auction or other means? Same with first tendered. The delivered load was it delivered using the carrier that was first tendered the load? And then the inflation that we measure across shippers and their lanes. If you look at all of those combined, we're seeing levels that are at or exceed the benefit we saw in the last soft market. So very much a buy side market, very much a shipper market. All of the indices that Mazen talks about from a general economic perspective align perfectly with what we're seeing in terms of the system. And you can see here the 2023 in orange versus the 2019, which is our last sort of pre-COVID trough market. We're not seeing any risk associated with not getting your primary carrier because, frankly, the rates in the market are very, very attractive, whether you're in spot or contract. Couple new things here. There's a little bit of a yellow color here on the top line. Basically, all we're doing is looking at the year-over-year change. And so the top row is the combination of all types of rates. So we're looking at spot loads. We're looking at, from FAM. We're looking at manually assigned loads. We're looking at contract loads. And we're asking the simple question, where do those loads compare over time to the most recent contract benchmark? So we take a benchmark that is sort of a curated data source. For van, it's the last full 3 months. For reefer, flat, and intermodal, we're looking at the last 6 months. We create machine learning models that work just like a route guide. It's basically going to tell you what is that rate for today's contract rate. And we use our TM platform, close to 300 shippers across all the modes. And we populate that in an anonymized way to look at point-to-point distance and cost to come up with a model. As we apply those benchmarks, it tells us for van, if you look at the combination of all the different types of rates, about a 31% drop just looking at the month, comparing the last full month of June to the prior June of 2022, and about 22% down for reefer, flatbed down about 12, and then intermodal down about 23. So very extreme conditions, obviously with COVID being such a tight market, difficult market, congested market, shipping lots of air kind of market, difficulties in setting appointments and production outages kind of market. We are now back into a more streamlined, productive, efficient market, and the supply side has yet to catch up from a pricing perspective. If you look at the second level of information there, we're just breaking down that top trend into 3 categories. The 2 to note are the blue and the black. The blue is what happens when a load goes to auction. What is its relative price to the most recent contract market? And you can see as the blue line passes through the black line, which is the contract trend, you'll notice the downward deflationary impact on the market. That's driven primarily by 2 main forces. Route guides that are performing better tend to get the first or second carrier in a much higher probability. That introduces deflationary impact, as well as the amount of bids that are coming in. We'll talk a little bit about that on the next slide. So contract rates continue to decline. The spot rate is very, very soft, and we're seeing the similar trends across all the basic surface modes for the U.S. The third row just tells us that we're kind of flat when it comes to auction loads. We are seeing a mix of shippers that aggressively go after spot rates, and they can use more of that in their network versus others. Typically, that's driven by the type of lane or the lead time they might have for covering a load. And then the fourth trend here you'll see across all the modes, very consistent trends relative to the first tender accept trends going back a couple of years. You can see just the massive improvement that we've seen. So all in all, it's a shipper's market. We'll talk at the end about our 12-month outlook, and we'll sort of end the discussion there. But in terms of what we're seeing for procurement, our record bid activity, we're seeing some pause and wait sort of activity. I won't steal too much of Mr. Lowry's content, but with the YRC closure, the LTL RFPs have now entered in a different territory than we saw 3 months ago. The strategic trends that we're seeing from a procurement side is only to bid out lanes that are out of market on cost, or you don't have a strong carrier relationship or have operational changes. So we're seeing a refinement of how shippers are going to market, how they're benefiting the relationships that they have, and how to make adjustments based on more of a segmentation. Brokers right now, we're seeing a lot of single source strategy by location and minimizing the number of brokers to focus on areas of the network that make sense for brokered loads. It does vary based on the aggressiveness we see. On the carrier side, we're seeing a lot more bids by carrier on lanes that typically would feel a little bit more like it's outside of their operational efficiency. So much more aggressiveness on bidding on mini lanes versus just focusing on the network, which is not a long-term strategy, but there's just a lot of competitiveness to win any and all lanes based on the conditions. And we're seeing a lot of aggressiveness from the broker community to capture market on contract rates. So we are still seeing double-digit savings. That will have to play out. We'll talk a little bit about that in our outlook. And we're seeing some increases in the LTL side, particularly with the YRC bankruptcy underway. So that's my quick update. I'm going to pivot it right over to Mr. Lowry and allow him to sort of do the deep dive here on the LTL sector. So Matt, it's all yours.
Okay, great. Thanks, Matt. Glad to be here today and to discuss LTL further. First, we'll start off with overall demand. And as Maison already discussed earlier, is that the PMI index for July was 46, and the PMI index is a very good indicator of future volume for LTL. It follows it very closely, so we expect lower overall demand from the market over the next several months, if not further. The big news is obviously Yellow filing bankruptcy earlier this week and stopped hauling shipments on Monday of last week, which removed approximately 9% of the market share out of the LTL market. And the interesting thing here to see is on the bottom left chart is the overall tonnage by quarter. So overall demand is very low, historic lows actually. So the gap between what Yellow's tonnage was and the highs from 21, 22 is actually less. So currently the market is able to absorb the volume, but as the thing to really watch is as demand grows, will the LTL market and LTL carriers, how will they be able to control their networks and capacity? Which brings us to, what are the key factors impacting supply? So these two charts on top here, the top left is, fleet sizes by carrier. So you can see in 21, 22, fleet sizes were at an all-time high, and they've really come down quite a bit to, follow demand. So carriers are trying to increase their fleet sizes, haul or hire drivers to support the future demand that the current demand that they're receiving from the Yellow business, as well as building up their networks for future demand to really set themselves up for growth. In the top right is the terminals. So you can see Yellow represented just short of 20% of total terminals. So, over time, the overall terminals within the LTL industry has gone down and will ultimately continue, but carriers individually are looking at buying additional terminals to either grow from a 50 terminal to a 100 terminal, or just expand their terminals network in order to support more volume. And of course, there is a cost to all of this, and for this growth, cost of hiring quickly and purchasing additional equipment and terminals, in addition to the traditional costs that continue to climb from a driver pay, equipment, and so on. So next, we want to talk about, what to expect from Yellow's closure. And you can look at it from a short-term and a medium long-term perspective. And really what we are, for the immediate and for the past couple months, really expect and plan for the worst and hope for the best. So in the short term, immediately over the past, 8 days, the influx of demand, the current LTL carriers have been able to absorb that volume. But really you want to plan for it. You want to keep close communication with your carriers as volume shifts. Even if you didn't use Yellow, your LTL carriers networks are changing, very quickly. So you just want to be prepared, have backups in place, understand that, on-time performance can suffer. There may be some short-term embargoes, as well as some carriers, if you are scrambling to get more carriers, especially national carriers or network, some are putting the pause button on pricing new business. From a medium and long-term perspective, really want to watch the LTL market demand. As showed earlier, demands are at a low. So as demands start to increase, that's when the carriers' networks will really tighten up, and they will tighten up at a faster pace than they historically have. And that's what carriers are really watching closely. They do not want to get to a point where they're over capacity, and most, if not all, were over capacity in the height of COVID. And that was really difficult for them to operate, and their on-time performance, really dropped through. They're trying to balance that perspective. And then from a pricing perspective, see on the bottom left two graphs, with Yellow removing from the market, they were the national carrier with by far the highest operating ratio and also the lowest cost per shipment. So you are taking away that lower cost national carrier. So in theory, the other national LTL carriers have less cost pressure from their competition, which evens out the pricing further. And we'll get into a little bit more on the pricing in the next slide. And then you just want to keep an eye out for the ripple effect. So as carriers' networks change, shippers' networks change, and one thing may want to you're pulling a carrier to replace Yellow, and then that carrier might be some pricing or capacity issues. So this will take, even though there aren't crazy issues with the market absorbing the volume, it will take some time for it to really pan out for long-term solutions as both carriers and shippers find the long-term solution that really works. So this will take some time to work through. So from what to expect from Yellow's closure from a rate perspective. So kind of want to look at it from two perspectives. The first is the primary reasons for increased rates. And there's a lot of market hype, flashy headlines. LTL rates are going up, and they've already gone up. So you just want to take that with a grain of salt, but there's certainly, they are out there within the headlines and even earnings reports as well. From a supply and demand perspective, there's obviously less supply. You removed 3 regional carriers, 1 national carrier, represented nearly 10% of the market. So there are less carriers, less capacity to manage the demand. Shippers reliant on Yellow will need to switch to a higher cost carrier. So as explained earlier, Yellow was overall a lower cost option. So if you have replacement options already in your stable of carriers, probably took a incremental cost increase there. So less exposure there, easier to keep your freight moving as well. But if you don't have other viable options available, expect a higher cost to replace. We're seeing various different stances that carriers are taking. Some, really just a couple national carriers are not taking on new business. Some national carriers are taking on new business, and they, if it is because of the yellow, they are potentially pricing a little higher due to the capacity needs, that the immediacy of it all as well. And then we're also seeing some carriers holding flat, really wanting to take this opportunity to grow. So we are seeing all sorts of different pricing behaviors. Then the unexpected change in freight mix. So the current, the LTL mix, their networks will change with this influx of business. So this will impact how their networks operate, that freight mix, their lane mix, just the type of freight that they're hauling. So it could have a long-term impact on their pricing. So some counterpoints to that are, understand the market hype. We aren't seeing evidence at a macro level that rates are actually changing. And from a supply and demand perspective, like I said earlier, demand is at an all-time low. So really, we don't expect too much from a pricing until actually demand starts increasing, and that's where networks will get tight, and then that is actually where pricing pressure will actually really be seen, like the 2021-22, what we've seen in that area. Rate stability, LTL carriers are generally very good about holding rates for 12 months, and you don't have that first tender accept like you do have truckload. They generally take what you tender them, with few exceptions. So the stability of rates is much stronger, and you have that your rate is generally good for the 12 months that were agreed to. Over the past 2 years, carriers have really corrected. They took 2021, early 22, took the opportunity to really correct their pricing and took advantage of that. So from a pricing standpoint, we do expect that rates to go up slightly because of this, but not into the teens and from a percent perspective, but just expect slight increases, but nothing substantial. So what can you do to avoid disruption within your network? From a tactical perspective, adjust your route guide to meet your needs, meet the carrier's needs. Be prepared to plan for service disruptions. Treat high priority shipments accordingly. Guarantee shipments for delivery. So just understand what's important to you, and just have a strong communication with your core carrier base, and understand their needs, and as their networks are changing, that you have that strong line of communication. Long term, you really want to use this time to strengthen your LTL processes and to become a LTL shipper of choice, because demand will ultimately increase and LTL networks will ultimately tighten up, and there will be a point in time where capacity will be tight. So some areas you want to look at, and you want to start now, is the origin optimization. Things to think about there are driver and equipment utilization. Really, when a driver comes in, to load or unload them quickly, or that those trailers that you have dropped at your facility, to on and unload those quickly. As well as the exchange of information. To exchange that, use electronic pre-assigned pro numbers to improve the carrier's efficiencies. Timely freight payment, of course, want to focus on that. That's a key metric that carriers look at. And pricing strategy, really want to align your LTL freight and business strategy with the right carrier mix. So you want to develop that pricing and route guide strategy that meets both your business goals as well as the carriers, and understanding where they're coming from as well. And that feeds right into carrier collaboration building that trust, and really help understand what the pain points are from the carrier, improve their efficiencies. And last but not least, focus on your packaging. As networks tighten up, and this was apparent a couple years ago, there's really a focus on those pieces of freight that are over 8 feet. So you want to, if possible, make your packaging as close to a 4x4x4 pallet as possible and easy to move, and in a way that is damage free. So you really want to focus on your packaging and improve that density, that pounds per cubic foot. So with that, I'll turn it back over to Matt.
Actually, Mazen's going to take us home, and then I'll tell the last one. Yeah, no worries.
Yeah.
Mazen,
Thank you, Matt.
Yep.
Thank you, Matt. So I'll be going over like some of the 12-month outlook and what we expect to happen over the next year, starting with what we're seeing on the demand side and the supply side. So as I mentioned before, on the demand side, we're seeing that the manufacturing sector is stagnating. It's still contracting. New orders and backlogs, which are the early indicators, are pointing to more weakness in the coming months. At the same time, we're seeing some correction in inventories. We're seeing resilient consumer spending and the recovery in imports. So given all of that, we see some recovery in demand, but there's no event on the horizon that's like a COVID lockdown or a stimulus check that will boost demand. So we expect demand to remain stagnant or have like some growth within the trend levels or below the trend levels. Now, having said that, the current spot rates are not sustainable. So as we saw as I published this in a blog post a few months ago, based on data up to April, and the chart on the left compares spot rates, contract rates, and the carrier's operating costs. And by the carrier operating costs, we mean the cost per revenue mile, which is mostly comparable to spot rates, as it accounts for not only the loaded miles, but also the empty miles that carriers incur the costs for. And this chart shows that spot rates have decreased to a level where they're below the cost per revenue mile, which means that almost every mile driven on the spot market is a losing mile, is a negative margin to carriers, and even the large carriers. Smaller carriers are likely to have a wider gap because they drive more empty miles and they incur higher costs, so they're not as efficient. So what is the means for this to correct? We believe that it has to be a reduction in capacity. And what are some of the indicators for that? The first indicator is that we're seeing carriers' margins are getting thinner and thinner. This chart shows the contract rate per mile versus the long distance truckload employment year over year. Usually the employment lags contract rates by about 10 months. So this is the other side of the story where we see some relationship between employment and rates, where higher employment drives rates lower, but at the same time, lower rates will drive employment lower, and this is how the cycle continues. And when we look at this chart, we see that the AT contract rates have been going down by almost 20% down year over year. And if the trend holds, that indicates that carriers, and especially in the long distance truckload sector, should be reducing their headcount by about 5% within the next maybe 12 months or so. So this is the first indication that supply is set to contract. Carrier margins are getting thinner, contract rates are getting lower, and that should translate to about 5% reduction in headcount, maybe 4 to 5%. Now, what this translates to, according to our estimates of the elasticity of price with respect to employment, that could translate to an increase in spot rates of 15% to 20%, simply because of the supply reduction. The other indicator that I wanted to discuss is what's happening with equipment orders and sales. So this chart is from ACT Research. Data from ACT Research shows the number of truck orders, truck sales, and builds. So usually when carriers need trucks, they place orders to OEMs. It takes a time period, which we call the lead time, between placing an order and receiving the truck. and that ranges between like 6 months to it has been as high as 20 months in the middle of the COVID pandemic. So usually what happens in tight markets is that we see production going below orders. So carriers are placing a lot of orders for trucks. It takes like a few months for these trucks to hit the market. And in soft markets, we see that production is going above orders. And this is what we're seeing right now. So we're seeing every month in the North American truckload market industry, we're seeing about 30,000 new trucks being sold to carriers, delivered to carriers. But at the same time, we see that orders have been much lower than that. They're in the range of maybe 12,000 to 20,000 per month. So this tells us that, well, right now, carriers are still adding equipment to their fleets. In the future, we expect this capacity addition to moderate and the number of tractor units sold to carriers to decrease substantially. So with that, I'll hand it over to Matt to go over his predictions for the next year.
All right, thanks, Mazen. Yeah, if any of you know me, I'm not a huge fan of predicting because I track people who do it for decades, and it's a bit of a random exercise. However, we are getting a huge amount of requests for what we think is going to happen in 2024 relative to the budgeting process. And so I'll just throw out that individual results vary subject to when you bid, how you bid, what's your portfolio broken down into high service, high volume lanes versus sporadic, unpredictable type of lanes and things like that. So individual results vary, but the net of all of this information is we're not seeing any shocks from the demand side in the 12-month forecast. We saw a lot of stimulus during COVID. We saw a lot of consumer behavior that was fundamentally different than anything we've ever seen. There still is a very strong demographic playing out in our economy with families and individuals in prime buying, and we have low unemployment. So there's still this demographic influence here, but inventories, the network, the productivity of the network, the efficiency of the network have all somewhat returned in the post-COVID world. We don't really see anything impacting demand, and there is some information out there in terms of savings rates and how they were inflated over COVID, and now there's a declining saving rate. And if you straight line the decline somewhere towards the beginning of next year, we're going to start seeing savings levels that were more consistent with pre-COVID levels. So the strength of the consumer, it's a debate among all economists, but we're not seeing anything that would shock the demand side of the system. Now, in terms of supply, we know we're oversupplied. And so the pace of that rebalancing is going to be the key contributing factor as to when capacity is more in line with a more normal market. And when I think of a normal market, I think of spot rates anywhere from 5 to 15% above contract. You're trying to figure out within my expected budget, if 10% goes of my volume forecasted out for a year, that 10% goes spot, and I'm paying 20% when I hit the spot. That's a 2% contribution to route guide leakage, if you will. So those types of numbers, I think we're getting into. The real question is, will the supply adjust before the end of the year? We're hearing weakness in the imports and other areas that would, for a retail season, you would expect a bit of a bump, but it's sounding like it's going to be fairly mild. So we're going to be oversupplied until we're not. And I think to some extent, Q1 is always a seasonal time where the volumes just drop into January, February, March. Pre-growing season, pre-seasonal season for produce and other types of markets. That's going to be a really tough quarter, I think, for any high OR fleets out there that are dealing with 20-30% less volume in their fleets. We've had a long, unprecedented growth cycle, and this contraction that we're seeing is taking longer, just because I think the scale of the COVID era was so long and so extreme that the contraction itself seems to be lingering on. So our expectation is for if you're looking at 2024 and you're thinking in the next 6 to 12 months, we would expect the contraction to bottom out at some point. There's some verbiage on LinkedIn and some opinions that we're in the uptick right now. I tend to disagree with that. I think we have some at least another quarter or two, maybe 3 quarters before we see that. It's open for debate, obviously. We're seeing that, if you look at the bids, we're expecting 3 to 7% inflation year over year for 2024 expense. And what that means is that if you're doing your bid in early part of 2024, it's a good chance that the capacity you have will hold. There aren't any pressing needs for carriers to start popping off of lanes and saying, we can't honor that rate. It's just mild conditions help the relationship. And we know the opposite is true just based on where we've come from. So 2024, you should be able to, the bids should hold until 24. And as those bids come in, if we have rebalanced the capacity to the demand, then I would expect just a normal year where you're seeing single-digit percentages coming into the bid on year-over-year comps that are fairly consistent. I think this would happen for all the modes. And at this point, if I had to bet on the demand changing to meet the supply or the supply lowering, I would say it's going to be the latter. So that's our forecast. And obviously, reach out to us if you are a customer. We actually have a very good line of sight to when you bid, how you bid, what your network looks like. And obviously, with all the QBRs that we're working on for our customers, we are trying to elevate the strategic conversation around what does this market mean relative to expectations for freight expense for 2024. So with that, I will turn it over to Rebecca for some Q&A, and we'd be happy to answer any and all questions. Thank you.
Thanks, you all. I thought that was a really great in-depth update of what's going on in all kinds of markets today. We have a few questions in the chat. Just a friendly reminder to put any other questions that you may have in the chat, and we will address them in the next few minutes. First question I'm going to throw to Mazen. So what data source supports a less hiring condition currently?
Yeah, thank you, Rebecca. So I covered a few of these in the slides. We are already seeing some reduction in capacity reflected by the BLS data. If you look at the monthly survey of hiring, we can see that truckload companies, all trucking companies, have been hiring less, especially LTL. Even before the yellow shutdown, we have seen a reduction in the LTL headcount. Recently, we have seen a reduction in the long distance truckload headcount as well. So this is one of the most important data sources to watch over time. The other is the FMCSA data. What's happening with trucking authorities and revocations. FTR provide a great summary of that on a monthly basis. And that also is showing that the number of carriers exiting the market has been outpacing the number of new entrants for the past 10 months or so. And finally, what's happening with truck orders and truck sales, the data that I showed from ACT Research, showing that orders are decreasing. They have been running below maybe their historical levels or even below the sales and builds of trucks. So all of these 3 data sources are pointing to the same conclusions. That is, supply growth is moderating, carriers are hiring less, and they might start, and maybe supply has reached the peak and is set to go lower over the coming months.
Okay, great. Thank you for that. And just a friendly reminder, we will send a copy of this presentation and our full market report after this webinar, along with a copy of the recording. So lots of assets for you and your team to share. All right, Matt Harding, can you re-explain what is the percent to contract charts?
Yeah, so for a given month, for every shipment in our system, for a particular mode, so say dry van, for example, we estimate the contract rate for every load. And so some loads aren't contract, some loads are spot. But what that baseline allows us to do is to measure the delta. And so as you can well imagine, if you drew a normal curve indicating the freight volumes for the most recent 3 months, the bell curve would be centered around 0. And so that 0 line is the contract market level for the current contract market. Where things get interesting is as we apply that same baseline. So for a given lane, it may be $1,000 is the contract baseline for today's market. Well, if I apply that to the same lane and the same shipments 2 years ago, it gives us a sense 2 years ago, where were we relative to that period of time? And what's really useful about that measurement is we're able to normalize for long haul, short haul, different aspects of that data to give a percent basis, which is very transferable over time and basically creates a unique contract number for each shipment. So, so when we look at how the macro trends that Mazen talks about and how they're influencing our pricing within our TM, we're using that as a sample of the market. So when you have lots of shippers and lots of data, and you look at those percent differences to a baseline, it becomes a very useful tool for us to understand, precisely what do all these external trends mean to a shipper. So as a shipper, you look at your data and you say, okay, our month over month, our data has dropped, 5, 6, 7%. That's very helpful to understand what your bid led to, what was the outcome and how is assigned to sort of the actions and the decisions you're making relative to how you use our technology, to how our shared services can help and everything like that. So it's a very powerful KPI for understanding where are you relative to the market and what's happening to the market overall. If that makes sense.
That's great. That is some proprietary information from your friends at Uber Freight for sure. All right, another question for Matt Lowry. Given the possible capacity constraints in the LTL market and the soft spot market, do you see shippers changing optimization rules to lower weight linear feet hurdles to put more partials into the TL market?
Yeah, I think that's a great opportunity because really those are the types of shipments, those shipments that are over 10,000 pounds that in a tight market that really clog up the LTL carriers networks. They generally represent about 5% of the shipments, but about 20% of the tonnage. So the more you can do that, the more stable the LTL carriers networks will be. So certainly want to look into partial truckloads, those multi-stop shipments and optimizing those, as well as looking at pooling options as well.
Great, thank you. Just kind of a generic question. I'm going to throw it to all of you for anyone that knows the answer. Do you see a similar trend in Canada? So maybe any of the big trends that we're seeing, what are we seeing up north?
The answer is yes. I think the economic, what's playing out post-COVID is playing out in a lot of geographies. I know Canada we started feeling the softening in the market, I think a little bit before they did. But by all accounts, capacity is fairly plentiful across, here and there. And the other thing too is our economies are very, very much linked. Obviously our Canadian brethren ship a lot of loads from Canada into the U.S. and try to get those trucks back. And so yeah, Canada is. I think the going joke is if the U.S. gets a cold, Canada sneezes or something like that. I think it goes one way or the other. But yeah, we're very, very much tied economically through NAFTA and other aspects. And I would say we do a very in-depth view of Canada in our quarterly market slides. So Rebecca, as you make that known, just know we've got to pull a lot of information from that market for folks that deal with it directly. And so I'm paraphrasing a little bit, but hopefully you have access to that and you can get a lot more detail. And by all means, feel free to reach out to us if you have more specific concerns.
Matt, that's right. We do go into more detail in that report, and we also cover other modes too. So we've talked a little bit about LTL today, but we'll cover intermodal and reefer and flatbed and some of those additional ones in that report, which is great. Okay, Matt Harding again. We normally utilize the EIA Fuel 2024 projection. Do you support that strategy?
We actually recommend it because it's the government forecast, and it's probably the one that's most widely looked at. I have done analysis over the decades, lining the projections up to the actual prices. And I would say they're fairly, they tend to be off a lot. So just use them with a grain of salt. I think a lot of times the information gap is just there. It usually comes from outside transportation, and you need a source. So there's no better source than a government trend. There is a gentleman by the name of Philip Berlegger, who is an economist out of MIT from the 70s, who's followed oil markets. And I use his site as well. Reach out to me if you need the link. Some of the interesting comments that have been made is that it's almost impossible to measure supply and demand in today's markets, because the strategic reserve has had such an influence on pricing that the techniques that were used prior to that sort of policy input, you could look at utilization at the refineries and the capacity and come up with some intelligent forecasting. But because of the releasing of millions of barrels of oil can happen based on a sort of a government policy, it's made it very difficult even for the folks who do this for a living to do it well. So some interesting information there. Feel free to reach out to me directly. I can tap you into some of the sources that I've looked at over the years and the ones I feel are very helpful. But EIA is the government. They do have a lot of great information on diesel prices and all the pads and all the actuals. So we do recommend going there first, just as it's a one-stop shop for all things fuel related.
Okay, there you go. We can, Matt, if you have that person's name too, we can certainly drop it into this Q&A box and share it out as well.
Yeah, I'll do that right now.
Cool. All right. Given the number of small carriers existing in the market, brokers seem to be struggling on load coverage in FAM. Is FAM a viable option given the market conditions? And this might be a tag team question for the Matts.
Mr. Lowry, you want to go?
If you want to take that one, if you don't mind.
All right. Rebecca, please repeat that. I was putting Philip Berlegger's name in the inbox. My apologies.
No worries. No worries. Okay. Given the number of small carriers existing in the market, or I'm sorry, I think that might be exiting the market. Brokers seem to be struggling on load coverage in FAM. Is FAM a viable option given the market conditions?
Well, I think it's important. Yes, it is. It's always a viable option. I think the key to FAM is to, and we're making lots of improvements for the carriers and from a product perspective. So all of that will be unleashed here in the short term. The thing to keep in mind about FAM is that brokerages aren't exclusive to just small carriers. We have any carrier out there may have their own sort of, partake in sort of brokered loads. Obviously, digital brokerage, we have a huge solution there, which fills a lot of gaps. And then you have sort of the traditional brokers. So I think in terms of big and small, and then where they sit in terms of whether they're just a provider or an intermediary, configuring the tool to work well, I think takes a little setup and a little thoughtfulness. But I see FAM as it's a great option for having a proper backstop relative to trying to find the best controls relative to freight costs. I can tell you, just from the activity we do from the data perspective, you can see within the first 10 to 15 bids, like a 40% reduction from the starting bid. Now, the starting bid's never really realistic, but you can quickly get to, depending on the time you have, quickly get to the answer in terms of where that market is as those rates start flattening out. And then we're also including, we'll have the capabilities to provide some assessment of what that spot level should, where we see it as, to kind of help facilitate the timeliness of getting those loads covered. So we've got a lot of product enhancements and a lot of other things coming that way. And over the years, I've seen that as a very effective way to minimize the time of getting a load covered. But it does take a little thoughtfulness in terms of how you configure it and set it up.
Okay, great. Well, thank you all again so much for joining us today. That's time. We will see you in Q4 for our next one. Don't forget to sign up for upcoming webinars that we've got. As Matt mentioned, we do have some exciting products headed down the pipeline as well that will hopefully solve for some of these challenges. See you next time. Thank you.
All right. Thank you.